Hey, it's Red. Welcome back to the channel. So with the volatility in the stock market lately, I've been getting a lot of questions from people wanting my advice on how to invest. And from these conversations, I've noticed 3 common errors in thinking that people seem to be making when it comes to investing. So in this video, I'm going to address a few of these topics that I think will help clear up some confusion for you and help you think more correctly about investing, especially in the current market environment. This is important because when there's blood in the streets, it's usually the best time to buy stocks, but you don't want to make a mistake that could have easily been avoided with a little education. So in this video, we're going to discuss how stocks go to zero, why buying stocks that have fallen the most isn't necessarily a good idea, and how to think about what stocks to buy and what stocks to avoid coming up. What's up, it's Red. If you're new to the channel, my videos are about helping you learn investing and make smarter decisions. I assume you're watching this video for a reason, so if you like what you see, hit that subscribe button to follow along with my future videos. And now that we have that out of the way, let's get into the video. Okay, so the first investment error I would like to address is the idea that just because a company or industry won't go away and the stock price has dropped a lot, that means it's a good investment. For example, over the past few weeks, you may have heard someone say something like, I'm going to buy airline stocks because their stock prices are way down and airlines aren't going away. Now, that statement may be completely true, but the thing is, the fact that the industry won't go away is not all that relevant to your investment decision, and I will explain why. Most public companies finance themselves with a healthy mix of debt and equity. They pay for things with a mix of their own money, equity, and they also borrow money from banks and other lenders, which is debt. For example, it's kind of like, let's say, home prices in your area drop a lot and you buy a house that you plan to Airbnb as an investment. You might put in 20% of your own money as a down payment and get a loan for the remaining 80%. Now, I would like you to consider that even though the house is not going away, does that mean you won't lose money on it as an investment? That it's bound to bounce back and be profitable? If you think about it, the answer is definitely no. But how can that be? In this case, the main reason you would lose money is probably if you ran into a cash flow shortage and aren't able to pay the mortgage, the bills, keep up with maintenance, etc. So after a while, the bank would repossess the house and auction it off to the highest bidder, which is usually at a price way lower than you bought it for. And many times you would lose most or all of your 20% down payment you invested, and someone else would now own the house. It works the same way with companies. When you buy a stock, you are buying an ownership stake, an equity position in a business similar to your equity position you had in that house. And many times publicly traded companies have a healthy amount of debt that they need to pay back. In addition to debt, there are many other contractual obligations companies may have, such as real estate leases, contracts with customers and suppliers, etc. And if they have a business hiccup and can't pay the people they owe money to, or to pay their employees, and their business can't keep operating, many times they will file for bankruptcy. Companies need cash for their day-to-day operations, and if their stores are closed, then there isn't that much cash coming in the door. But just because a company files for bankruptcy doesn't always mean the stock goes to zero. But many times a reasonable plan can't be formed to get them back on track. In this case, what happens is the people who own the debt take over ownership of the company, and the value of the equity that you own goes to zero. Now, in the case of our current situation, lenders are offering temporary relief of debt payments, and the government is going to step in and help out, but it's unclear exactly to what extent. So it's possible that a lot of companies could go broke even though demand for their product or service will still exist in the future. The point is that just because a stock will be around and there's future demand for that product, the equity value, aka what you own, might still go to zero and you could lose all your money. But don't get too discouraged by me saying this. I think there are probably some great investment opportunities out there right now. And if you have a diversified portfolio built and don't put all your eggs in one basket, you will avoid losing money when some companies inevitably go broke. All right, let's move on to the next topic. Okay, the next error I've seen people make is they blindly buy stocks that have fallen the most. Over the past few weeks, you may have heard someone say something like, I bought fill in the blank company because it dropped a lot. This way of thinking is along the right lines. Usually, if you like a company and the price falls, you're getting a better deal than you were before. But the economic environment has changed. Stock prices reflect investors' expectations about the future. So the companies that have fallen the most are likely the ones that will suffer the most. The market efficiency hypothesis proposes that at any given moment, a stock price properly incorporates all available information about a company and is the best estimate of its true value at any point in time. As markets absorb more information, prices adjust to reflect that new information, and over time, stock prices will converge to what their true value should be. The stock market is prone to overreacting to fear and optimism, but overall, it's a pretty efficient vehicle at valuing companies. The companies whose stock prices have fallen the most are probably the ones who will be in the most trouble. This isn't always the case, but I would say generally that if we have a 30% market crash and you see a stock dropped by 80%, that company is probably at a high risk of going broke. It's not guaranteed that it will recover to the value it was trading at before the crash. In order to buy companies that have fallen a lot, you would need to develop what's called a variant perspective. A variant perspective is exactly that, a perspective that varies from the consensus. To be successful, you must have an outlook that is different from what everyone else is thinking, and you have to be right about it. In simple terms, it's not enough to just buy companies whose stocks are down a lot. Your real aim should be to buy companies who are down too much. The price being down means the consensus opinion is that the company is likely to struggle a lot in the future. So to buy something that's down, you have to understand why it's down too much, why it has gone down more than it should. And your opinion can't be because it's not going away in the future, because now you know that that is not sufficient. A more relevant question is, how long can this company weather the storm based on its cash flow and how much debt they have and what payments they need to make in order to stay afloat? So let's move on to the third tip. And if you're getting any value from this video, please make sure to smash that like button down below. Okay, the flip side of the previous tip is don't just blindly buy companies that are seeing a short-term surge in demand. A lot of people I talk to want to buy stocks like Zoom or Slack because so many people are working from home, or they want to buy Netflix because a lot of people are chilling watching Netflix right now. This is an example of what Howard Marks calls first-level thinking. To quote from his book, your thinking has to be better than that of others. You must think of something they haven't thought of, see things they miss, or bring insights they don't possess. First level thinking says, it's a good company, let's buy the stock. Second level thinking says, it's a good company, but everyone thinks it's a great company and it's not. So the stock is overrated and overpriced, let's sell. To be a superior investor, you need to possess second level thinking. You need to go against the consensus. You have to understand a situation at a deeper level than other investors. You need to take into account both how good the company is and what price you're buying it for. No stock is so good that it can't become a bad investment at too high a price, and there are few stocks that are so bad that they can't become a good investment at a low enough price. The problem with blindly buying stocks that perform well in the current economic environment is that everyone else also knows they will perform well. It's obvious. And stock prices of these companies have already likely increased to reflect this information. I would guess that by buying a company like Zoom right now, you would probably be just buying a really expensive stock. Now, if you can determine why the company is actually worth more than what's reflected in the stock price, then feel free to buy it. Maybe a company like Zoom will not only benefit in the short run, but also in the long run due to basically all of America now understanding how to use their software. And based on the current valuation of the company, you think the stock is still cheap, even though it has already gone up. I'm not sure if that's the case or not, but that would be an example of second level thinking or maybe even third level thinking. So hopefully that clears that up for you. Now let's finish with a quick summary. We learned that to be a good investment, it's not enough that a company won't go away in the future. What's relevant is if the value of your equity or ownership stake in that company is going to survive. We learned that buying stocks that are down the most is not necessarily a good idea. It's in the right ballpark, but you need to do some more research to determine why that company's stock has gone down too much. And third, we learned that buying stocks just because they will perform well in the short term is not a good idea. That's how most beginners invest, what we called first level thinking. And investing this way is likely to just cause you to buy expensive stocks. Again, if you can determine why it's still a good buy, even though it's already gone up in price, then go for it. If I had to sum up the main idea behind this video, it would be that there are certain principles to investing that successful investors follow. If you want to be successful in anything, you have to do the things that bring about success in that domain. So in this case, to be a successful investor, you have to do what successful investing is. You don't just get to do whatever you want. If you wanted to be a successful UFC fighter, you couldn't just run out into the octagon and do whatever you wanted. You'd get your ass kicked. The same thing applies in investing. It's important to take a step back and ask yourself, am I doing what a successful investor would do? Am I acting in alignment with the principles of successful investing? Do I even know what those are? Or am I just acting on my own random impulses and emotions? There are certain behaviors that get people money and other behaviors that lose people money. And over time, they haven't changed. Warren Buffett says his favorite investing book is still The Intelligent Investor, which was written in 1949. And the stuff written about in that book is basically the same stuff that's written about in today's investment books, just in more modern language. The principles of business and money and human psychology don't change. The things I talked about in this video aren't just random opinions that I made up. I learned this stuff from other successful investors, and my goal with these videos is to take that knowledge and distill it into an easy to consume format here on YouTube for you. So I hope this was helpful to you. I'm planning to do a lot more videos and maybe some more in-depth courses in the future about creating investment portfolios, investing in general, how to think about building wealth and making money. I have a lot of ideas, but if you have any specific things you would like to learn about or any questions you have, please let me know in the comments below. I would love to hear from you. So demolish that like button if you got any value from this video. Subscribe to the channel if you haven't already. Hit the little bell icon next to the subscribe button to get notified when I post new videos. I appreciate you, and I'll see you in the next video.